Everyone thought the housing market had already bottomed out, but it turns out it kept digging. Right now, more than half of U.S. homes are selling below their asking price. That's not just a little dip. That's a sign of a market under real pressure. In fact, Redfin's own head of research, Chen Zhao, admitted to Bloomberg, "We thought we hit rock bottom, but we keep discovering there's more rock bottom to be had." So let's talk about what's really happening, what the experts are saying, and what it all means for you if you're trying to buy, sell, or even just sit tight in this very confusing market. So let's dive right in. From April through June, which is normally the hottest time of the year for buying and selling, home sales actually fell to their lowest level since 2012. Think about that. The busiest season in real estate turned out to be one of the slowest markets in over a decade. And part of that slowdown comes from an unusual imbalance. In April, there were 34% more sellers than buyers. That's the widest gap since Redfin started tracking data back in 2013. So not only are fewer homes selling, but there are way more homes sitting, waiting, and not moving. And when homes do sell, they're selling for a lot less. As of May, 56% of US homes closed below their asking price, with the typical sale going for around $45,000 under list. That's a huge shift from the bidding wars we saw just a few years ago. Veteran Atlanta agent Glenda Baker put it bluntly, "People say price solves everything, but price doesn't solve uncertainty. Even when sellers cut prices, offers aren't flooding in." Now, some markets are feeling the sting more than others. In Naples, Florida, home prices have dropped 15%. Miami's sales volume is down 37%. Meanwhile, in places like Newark, Detroit, and Cleveland, prices are holding steadier, but homes are taking longer to sell, averaging around 40 days on the market. Nationwide, active listings are up around 13% year over year. More homes for sale sounds like it should help buyers, but demand is still sluggish. Behind those numbers, there's another story playing out. Homeowners under stress. In Austin, about 14% of homes are at risk for selling less than their owners paid. Nationwide, about 6% of homeowners, many of them who bought during the pandemic frenzy, are now staring at the possibility of losing money if they sell now. On top of that, nearly 40% of FHA borrowers missed a mortgage payment in the second quarter of this year. And foreclosure filings are climbing up too, with more than 187,000 properties flagged in the first half of 2025, a 5.8% jump from last year. Foreclosure starts are up 7%, and completed repossessions are up 12%. This is all from Atom data. That's not exactly the foundation of a healthy housing market. So what's driving this? A lot of it comes down to mortgage rates. Right now, they're stuck in the high 6% range. And for most buyers, that's just not comfortable. But here's where it gets interesting. Oxford Economics says even a modest drop could be enough to shake things loose. Senior economist Bob Schwartz told Fortune, "There's no quantifiable rate that would trigger more home sales, but just a 1% drop in mortgage rates to below 6% should be enough of an incentive for at least some homeowners to sell their homes and trade up." The problem is that millions of homeowners are locked into mortgages at 3 or 4%. More than half of all outstanding mortgages in the United States are in that range. So if you're sitting on a 3% loan, why would you sell your home just to take out another mortgage at 6.5%? For many, it just doesn't make financial sense. This is why the market feels frozen. As Schwartz put it in his August 8th note, the housing market would be the biggest beneficiary of lower rates, as they would unlock frozen sales by homeowners who are reluctant to give up the low rate mortgages taken out in the decade following the Great Recession. But here's the reality check. Lower rates alone won't fix affordability. Luxury broker Michelle Griffith told Fortune, "Inventory is tight and competition is high. So the cost of the property itself is what keeps most buyers on the sidelines." In other words, even if rates drop, prices are still so high that many buyers simply can't afford to play the game. That said, there has been a small window of relief. By early August, the median monthly mortgage payment fell to $2,631, down more than $200 from its May peak. Mortgage rates dipped to 6.53%, the lowest level in 10 months. That little shift gave buyers on a $3,000 monthly budget about $20,000 more purchasing power than they had just a few months ago. But here's the warning flag. Redfin's Chen Zhao says buyers might already be too late if they're waiting for the Fed. She explains, the mortgage rates that buyers can lock in today have already priced in the likelihood that the Fed will cut rates on September 17th. That means mortgage rates are unlikely to drop any further when the Fed actually makes the expected cut. And the window to snag a mortgage rate in the mid-sixes may be limited. So if you're waiting for the Fed to officially cut rates, you might be standing in a line that's already closed. And speaking of the Fed, that's the wild card everyone is watching. Inflation held steady in July at 2.7%, the same annual increase we saw in June. That number was actually better than expected, and it pushed financial markets to predict a 94% chance of a Fed cut rate in September, up from 85% before the inflation report came out. But here's where things get complicated. Core inflation, which strips out food and energy, actually ticked up to 3.1% annually, and shelter costs are still climbing. Jake Cramell, a senior economist at Realtor.com, cautioned, a Fed cut doesn't guarantee relief, as 10-year Treasury yields, inflation expectations, and the bond market's reaction all factor in. If inflation runs hotter, the path for mortgage rates gets cloudier. So yes, a Fed cut looks very likely, but will it be the magic bullet the buyers are hoping for? Probably not. Mortgage rates could get stuck in this mid 6% range for longer than anyone would like, especially if inflation proves stubborn. When you put all of this together, here's the picture. Sales are at decade lows. More than half the homes are selling below asking. Mortgage rates are still high, and affordability is stretched thinner more than ever. Even though payments have eased a little bit, that relief is fragile. And while the Fed may cut rates in September, those cuts are already baked into the market. So what does this mean for you? If you're a buyer, mid 6% mortgage rates might actually be the best opportunity you'll see for a while. If you're a seller, know that buyers are cautious and negotiating hard. So pricing strategically matters now more than ever. And if you're just watching from the sidelines, understand that the housing market is at a breaking point. The next few months, especially after the Fed's September meeting, could set the tone for years to come. Chen Zhao said it best. We thought we hit rock bottom, but we keep discovering there's more rock bottom to be had. The question is, when do we finally hit solid ground? So let me ask you guys, do you think that a Fed rate cut will actually unlock this housing market? Or are home prices still too high to overcome, no matter what happens with the rates? Drop your thoughts in the comments below. And don't forget to subscribe, because this story is far from over. If you want more housing market news, check out our last video on the housing market, where Sydney Lake from Fortune magazine summed it up by saying, if you thought the housing market was bad enough, buckle up. We go into why she said that and other experts' opinions on the housing market. Thanks for watching. I do appreciate it, and I'll see you in the next video. Bye!